This is Ralph Bender with Enduring Wealth Advisors, about to beginning our quarterly conference call with Joe Tanius of J.P. Morgan. You can see on the screen, this is securities and advisory services are offered through LPL Financial, a registered investment advisor. If you are calling in later, you'll actually go to our resources tab and articles or videos and interviews to see the replay of this session. We are hoping to do a quarterly guide to the markets call with going forward and do one just for guide to the markets. We'll see how it goes this time. So with that being said, I'd like to introduce Joe Tanius. And Joe, I know you're on the line, so let me know where we go. And if you would be kind enough, people, to keep your phones muted. But if you do want to jump in, Joe's going to open up for questions and answers after about 20 minutes of conversation. So thank you. Joe?
Thank you, sir, and thank you for having me on the call, and thank you, everybody, for dialing in. I know it could be difficult to take some time out of your day, and so I promise to keep this relatively brief. I want to keep my comments relatively brief, and just kind of want to share with you our thoughts on where we see global economic growth and what the markets are looking at from what the markets look like, I should say, from a 30,000-foot level. And so what you're looking at here on page 41 of the Guide to the Markets is just a snapshot of quarterly economic growth for a number of countries around the world. And the way that you read it is like this. You look at these gray bars. They represent the last 4 quarters worth of economic growth. And then you have the light bars, the light blue bars, and those would represent forecasts for economic growth over the next 4 quarters. So this is by no means meant to be a long-term view or a long-term prediction in terms of what's happening with economic growth. It's simply meant to provide you with some perspective. Where have we been? Where are we? And directionally, at least, where do we think we are heading? Now, there's a lot that we can pull off of this page and a lot that we can say about each of these individual countries, but I'll share with you maybe just some big picture takeaways. First off, I want you to notice that the top half of this page and the countries on the top half of this page represent the emerging markets, and the countries on the bottom half of this page represent the developed markets. And then I want you to note that they're actually on the very same scale as you can see at the far left. The emerging markets continue to grow at a rapid pace despite the fact that we're seeing some slowdown in parts of the developed world. A lot of people ask me, do you think that what's going on in Europe, for example, or this deleveraging process that we're going through in the public sector, both here in the U.S. and abroad, is going to potentially drive us into some type of global recession? It should be pretty clear by looking at this that the emerging markets continue to grow at a decent clip, despite the fact that we're seeing some slow growth here in the U.S. It's all part of a long-term secular growth story which has been driving this decoupling theme, if you will, between the emerging markets and the developed markets. There are, I think, a ton of statistics that support this theme of this decoupling, but I'll share with you my favorite because I think it's very powerful and it resonates with me at least. It said that if you look across all of the emerging markets over any 5-year period, so over any 5-year rolling period across all of the emerging markets, you'll notice about 350 million people migrating. They start off in these farms and these very rural areas, and then they urbanize into city centers. Think about that. Every 5 years, you have a population of about 350 million people across all of the emerging markets moving from farms into cities. That's more than the population of the entire U.S. migrating every 5 years. That trend, that growth story, that consumption-driven story, that growing middle class in the emerging markets, that is what continues to support this decoupling theme and sort of this long-term secular growth story taking place in the emerging markets. Now, within that long-term secular growth, obviously you have cyclical ups and downs. And as a matter of fact, if you look at the gray bars at the top of this page, you'll notice that last year we were in the midst of a cyclical slowdown really across all of the emerging markets. I think the one that caught everyone's attention by eye and what was mostly debated, of course, was China. Because if you look at that, you'll notice the second set of bars in the top left, growth in China was actually slowing down considerably. Being the world's second largest economy with a population of about 1.3 billion people, many economists and many strategists out there were really starting to worry that growth in this economy was going to collapse, and that would lead to risk assets around the world capitulating. Fortunately, that didn't happen, and as you can see by that last gray bar, things in fact did tick up a little bit. And we've always maintained the view that China can probably engineer a soft landing, meaning maybe you're not going to continue to see double-digit growth in China, but we do think you're probably going to see it come in well above 7.5%, possibly touch 8% at some point later this year. And of course, as China grows and China recovers, that has a huge impact on other economies in the emerging markets, as you know, because obviously many of these countries in the emerging markets trade heavily with China. So overall, as you look at those blue bars, this year we do think we're going to see a cyclical bounce back or a cyclical recovery across the emerging markets, and it's really going to be emanating from Asia. Now, if you look down to the bottom and we think about last year, that was kind of a tale of two different stories. You had the United States, which you can see, second set of bars on the left, was growing at a pace of roughly 2%. Very, very difficult to get excited about 2% growth here in the U.S. And we'll talk about the U.S. in more detail in just a minute, but if you think back at growth in the U.S. over, say, the past 50 years, GDP growth has actually averaged roughly 3%. So when we talk about growth at 2%, it's just very difficult to get excited about that because right off the bat, you're growing at about 1/3 the pace at which you should be growing at if everything was sort of normal. However, when you compared the U.S. to the rest of the developed world, especially last year, well, it was kind of like the best house in a lousy neighborhood. Because, of course, as you look at Europe, Europe's been, dealing with this recession. It's been contracting for the better part of the year. And the issues we've been dealing with in Europe are obviously being exacerbated by all of the austerity, which continues to get enforced on many of these economies. Now, we can talk about Europe in more detail if there are any questions, but I think the million-dollar question and what we were asked last year time and time again was this. Since Europe is clearly in a mess, and they've got this monetary union, but they lack this fiscal union, we know eventually how that needs to end, do we want to be out of European equities? And if you think back to last year and you look at some of the 2012 performance, you'll notice that some of these countries in Europe were actually the best performers in the world. You had Germany, which posted an a market performance. Germany's stock market came in just under 30% for 2012, depending on which index you look at. And Greece of all places, Greece's market rallied about 34%, again, depending on which index you look at. The message here and what we learned, the lesson learned, I should say, was very, very clear to us. It's that markets don't need to believe that the issues in Europe are resolved in order to outperform, but they need to believe that the issues in Europe are contained. And one thing has been made very clear to us from European policy leaders is that they not only have the ability, but they also have the will and the desire to contain the issues. We continue to take 2 steps forward and 1 step back with Europe. And I think what happened in Cyprus is probably a perfect example of taking 1 step back. Again, we can talk about Europe to the extent anyone wants to, but overall we appear to be heading in the right direction, but it is happening at a painfully slow process. Now, to focus in here on the U.S., you can see those light blue bars. Our forecast for economic growth hasn't changed a whole lot. We're actually expecting growth in the first quarter of this year to have come in just over 3%. So pretty good considering what we saw in the fourth quarter of last year, but it still averages to about 2%. And many people are now focusing on the jobs numbers that we got 2 Fridays ago. If you remember, those jobs numbers were actually quite disappointing. And on page 25 of the Guide to the Markets, which we'll turn to in just a second, you can get a snapshot at just what's happening in the labor market. Now, what you have on the left side of this page shows you the unemployment rate. And of course, it's recently ticked down just a little bit to 7.6%. But you look at that unemployment rate, and I want you to understand just what exactly that captures. The unemployment rate captures all of those people who are searching for a job, which means if you are not searching for a job, you are not captured in this statistic. So what I'm basically saying here is anytime you see the unemployment rate go up or go down, it isn't necessarily a good sign or a bad sign. You have to dig a little bit deeper because it's very possible that over the course of a month you have less people searching for a job, and as a result of that the unemployment rate goes down. But conversely, it's also very possible that you have more people come out and say they want to start looking for a job because they're hearing of their friends starting to get jobs. And guess what? As they dust off their resume and get back in the game, start looking for a job, you'll actually notice that unemployment rate tick up, which again isn't necessarily a bad sign. I think it's important that you take a step back and just look at this big picture. Because if you do that, then you can see that the unemployment rate is in fact gradually coming down and the labor market is healing. Perhaps what I think is maybe one of the most important charts as it relates to the labor market is what you have on the right side of page 25. Now, the way that you read it is this. Anytime you see these bars above the horizontal axis, it means that we are gaining jobs at a faster pace than we are losing jobs. Anytime you see these bars below the axis, obviously the opposite is true. It means that we are losing jobs at a faster pace than we're gaining jobs. So what you have here is a chart that starts in 2003, and you can see the aftermath of the tech bubble there. Of course, we're losing some of that data because we try to keep this chart to 10 years. But then you have about 5 years or so of an economic expansion where times were great. We were gaining a ton of jobs. You had a bull market in the stock market, and the market rallied, I believe, over 106% over that time frame. And then comes the worst recession that you've had since the Great Depression, where we lost approximately 9 million jobs. We were at a point where we were losing approximately 800,000 jobs a month. This is why so many people today feel the way that they do. This is why consumer psychology and behavior has just been battered, and this is why investors are so reluctant to embrace risk. And can you blame them? I mean, take a look at that. That is just very, very severe. Now, what I think is really important to note about this chart as an investor is this. There is a big difference between a weak economy, which is continuing to get weaker, and a weak economy, which is gradually improving. And likewise, there's a big difference between a weak labor market, which is continuing to deteriorate, and a weak labor market, which is gradually improving. Make no mistake, the labor market today is weak. There's still a ton of slack, and we still have a long ways to go. However, the far right of this chart should at least put things in perspective, because we've now regained roughly 6.5 million of the 9 million jobs that we've lost. We still have a long ways to go, but we are at least heading in the right direction. And the other thing that I'd point out is so many critics were coming out on TV and in the media and saying, oh, the jobs numbers that we got last month were actually awful. We only added 85,000 jobs in the private sector. And so if you can just imagine those bars, the very next one that came out just 2 weeks ago would be up 85,000. That's kind of pathetic. However, I want you to notice just how volatile that series is. What that really means is that one number, good or bad, does not constitute a trend. It is an estimate when those numbers come out, and it's an estimate with a high degree of error. For example, when we ran the numbers and we punched in, all right, 80,000 jobs or 85,000 jobs actually were added last month in the private sector, the standard error was 80,000. Think about what that really means. The government estimates that we added 85,000 jobs last month, but with an error of approximately 80,000. Just put that in perspective. I think the overall theme here remains in place. As you look at both of the charts, whether it's the one on the left or whether the one on the right, the labor market here still has a long ways to go, but it's at least moving in the right direction. Now, there are some bright spots as it relates to the U.S. economy. It's not all bad, especially as we think about what's going on in the labor market. And there is one page that we have on the household balance sheet, which I think makes sense to highlight, and that is on page 20. Because on page 20, we're taking just a quick look at what exactly is going on with consumer finances. I think on the left side of page 20, there's some interesting stuff as it relates to the consumer's balance sheet. And so you can see actually just how total assets compare to total liabilities when you look at consumers collectively. And you can actually see how total assets compared today relative to where they were back in the peak of 2007 in that white box all the way at the top left, as well as what they were back in the low. And you'll notice that the consumer, for the most part, has actually seen a recovery or has already recovered in all of their assets collectively. Of course, the one thing that hasn't fully recovered isn't so much their investments, because we know that's recovered. It's really the value of their homes. And again, there's another bright spot there as we think about what's going on in the housing market as it continues to recover. And we can certainly talk about that if there are any questions. But what I really want to point your attention to are the charts on the right. The one on the top right shows you the household debt service ratio. it's really just a way of measuring how leveraged the consumer is today. We're basically saying if I take a look at consumers' paychecks, what percentage of that paycheck are they using to service their debt payments? And you'll actually notice that from 2007 to where it is today, the consumer has already gone through their deleveraging process. You know, we focus so much on the public sector and how much debt the government has and how this deleveraging process on the public sector is going to affect economic growth. And there is clearly some truth to that. But one of the things that we want to highlight here is that while the public sector has added leverage, the consumer has already gone through their deleveraging process. And not only do corporate balance sheets look healthy, but consumer balance sheets look healthy. As a matter of fact, if you take a look at that chart to the bottom right, that's taking a look at household net worth. And one thing that I'd add is that in the first quarter of this year, in 3 short months, household net worth, by our estimates, increased by $3 trillion. Think about that. Just in the United States, household net worth in 1 quarter, in 3 very short months, increased by $3 trillion. And you put that in perspective relative to the size of the U.S. economy. The U.S. economy is about $16 trillion, which means household net worth improved by about 20% of the size of the entire U.S. economy in 1 quarter on the back of an improving stock market and an improving housing market. So there are clearly some bright spots, and at the same time, while there are risks, there are clearly some areas in the market which continue to look attractive to us and continue to make sense to us. I'll leave you guys with 1 page, and then I'm happy to talk about any questions that you have, and that's page 6 of the Guide to the Markets. And the reason I like going to page 6 is because I think it puts things in perspective. What you're looking at on this page is simply the price of the S&P 500 going back to 1997. This is literally the roller coaster that investors have had to ride by sitting in stocks over the past 15 years. Think back to where you were December 31st, 1996. You hear of all these exciting things going on in Silicon Valley. You got the economy, which is booming. You hear of all this cool stuff happening in technology. You get into the markets and you ride it all the way up about 106%. You'll then notice at the very, very peak there, the multiple on the S&P 500 or valuation is at 26 times earnings, which is kind of expensive because we haven't really ever seen that before, like ever. People are coming out and saying maybe now is a good time to be getting out of the markets, but unfortunately, a lot of people basically look at the return that they've had. They say, well, there's no catalyst for it to change. I want to keep riding this up. I want to keep going. Unfortunately, we knew how that ended. There, in fact, was a bubble in the stock market. And investors went on to lose roughly half the value of their portfolio in stocks all the way down to October 9th, 2002. Sadly, this is when a lot of investors were getting out of the markets. A lot of people tend to get in the markets when they're high and get out of the markets when they're low, really because of how they feel. The interesting thing, however, is if you think back to some of Warren Buffett's, I think, most famous quotes, or one of his most famous quotes that I like the most is this. It says, be fearful when others are greedy and be greedy when others are fearful. If you, in fact, recognize the fear in the markets and you actually stayed in the markets and you rebalanced, you then went on to ride another 100% rally all the way up to the top October 9th, 2007. You can there see the multiple is 15.2 times. Clearly not a stock market bubble. Unfortunately, there was a bubble somewhere else. It was in housing. That housing bubble, once it popped, it was so highly leveraged, and that leverage was misunderstood and intertwined, that when it eventually popped, it took down the entire financial system with it and the global economy, and that, of course, led to markets capitulating and falling off, where investors once again lost over half the value of their portfolio in a very, very short time frame. March 9, 2009, the multiple's at 10.3. For those investors who actually had the nerve and the guts to get into the market because of the valuations and recognizing that things were actually going to start getting better, despite the fact that people were very, very nervous and fearful, you then went on to ride another 130% plus rally all the way up to the top to where we are today. And of course, as you can tell, this ride-up's been just a little bit bumpier than I would say the previous 2 markets. Now, the reason I like this chart is if you were to show this to a 6-year-old and ask that 6-year-old, what direction is that chart likely moving in next? My guess, 9 out of 10 of them are probably going to tell you it's going to go down. See, what this chart shows you is price, but what it doesn't actually show you is what you are paying for that price. in the end, when you go in and you buy a stock, it's important to take a step back and remember what it is exactly that you're buying. The most basic definition of stock ownership is that you are going in and buying your share in a business. You're buying your share in ownership in a company. And as an owner in that company or in that business, you are entitled to your share of profits. So if I'm debating whether or not I want to get into the market, the price isn't really the most important thing. It's what is the profits that I'm actually getting based on the price that I'm going to be paying. And you can see there that today the multiple stands at 13.8 times earnings. Well, how does that compare relative to the previous two peaks? And are we really at a market peak? Well, we put that box there for you at the very top, which highlights this peak relative to the previous ones. You got a PE ratio or a multiple of 13.8 times earnings. So you are basically buying 13.8 times earnings for every dollar of price, if you will, that you're getting into the markets, which is far less than what it was back in October of 2007 at 15.2. And note, of course, that was not a bubble in the stock market. It was a bubble in the housing market. But even so, it's less than that. And that 13.8, of course, is about half of what it was back in March of 2000, where it was at 26 times. You have a dividend yield today in the equity markets of about 2%. That's about double what it was back in March of 2000 when it was at 1.1. And then, of course, if you take a look at interest rates today, in the 10-year Treasury at 1.9%, even a little bit lower than that now, about a third of where it was back in March of 2000. All of these signs lead us to believe that markets still have some room to run if you're a long-term investor. Now, the pace of the rally which you've seen in the first quarter, where the market put up over 10% in 3 months alone, is that likely repeatable? Anything is possible, but I certainly wouldn't hold my breath. Because if that were sustainable in the first quarter of the year, you can basically say, okay, what if I just take that 10% I earned in Q1, and if I want my annual return, I just multiply it times 4. And then you quickly realize that a 40% run in the market, while it's obviously possible, is nothing you want to hold your breath on. Markets directionally, we believe, have some room to run here. And if you are, in fact, a long-term investor, the best strategy that we've found has always been one of developing the right asset allocation approach, having a diversified portfolio, and then, of course, rebalancing as needed. And I'm sure your advisor, Ralph, can talk to you a lot more about that based on some of his favorite slides. So I'm going to pause it there. I promised I wouldn't go more than 20 minutes. We covered a lot of different things, but I just want to see if there are any questions or comments either on the economy or on the markets or on anything else that's on your mind.
Thanks, Joe. In case nobody jumps in right away, you had talked about the deleveraging on the public sector. At what point do you anticipate something along those lines happening, and what would be the ramifications in layman terms?
Good question. So we actually have a page on that where we can take a look at what's going on in the public sector, and that's on page 23. And if you take a look at page 23, on the left side of page 23, what you've got here is the deficit as a percentage of GDP. And so just a quick lesson on deficits. Anytime you see the deficit shoot up, like it did, for instance, in 2009, what that really means is the government is spending more than it's receiving in tax revenues. Right? That's the basic gist of a deficit, right? If you're running a deficit, it means you are spending more than you are bringing in. And so you could think of a government spending more than it's bringing in as essentially a way of trying to stimulate the economy. Because if it pulls back on this deficit, it's actually, theoretically, going to help contract the economy. So anytime you see a deficit shoot up, theoretically, it should have an additive effect on economic growth. And so if you think about, for instance, in 2009, you had this huge stimulus that was pushed into the system, fiscal stimulus that is, and that, of course, leads to the jump in the deficit. Now, the opposite is also true then. Anytime you have the deficit come down, whether it's a reduction in spending or it's an increase in taxes, however you want to slice it and dice it, that would actually create a drag on economic growth. So whereas increasing your deficit or stimulus has an additive effect on economic growth, decreasing your deficit or enforcing austerity, which is the same exact thing, simply means that it's going to have a drag on economic growth. And you can see that from 2009 to 2012, the 4 gray bars just to the left of that dotted line where it says forecast, you can see we've actually been chipping away at the deficit over time. As a matter of fact, we've been chipping away at the deficit over the past 4 years at a rate of about 1% per year. Now, I don't know if you remember what I said we've been growing at here in the U.S. for the past few years, but we've been growing at a pace of about 2%. I also said that average economic growth here in the U.S., if you look over, say, a 50-year period, is roughly 3%. Well, if the economy grows on average at a trend pace of 3%, and we've been going through this deleveraging with a drag of about 1% a year, 3% minus 1% equals 2%. And this partially explains why economic growth has been somewhat weak over the past 3 or 4 years. Now, the big concern, of course, is what happens if you end up reducing this deficit too quickly? Does that end up pushing you into some type of a recession? And the difference between the gray bar just immediately to the left of the dotted line and the gray bar immediately to the right of the dotted line was essentially the fiscal cliff. And fortunately, the fiscal cliff was avoided. And you can see as a result of this New Year's compromise, you now have this orange set of bars that you can focus on, meaning we are actually chipping away at our deficit, and it is slowly falling. Maybe not necessarily the way that we'd like it to fall, but it is gradually falling down to under 4% over the next couple of years. And it just so happens that 4% is kind of that magic number. If the U.S. economy grows in nominal terms at a pace of about 4%, you can actually bring the deficit down to 4% in order for debt levels to stop rising. And that's why when you look at the right side of page 23 and you look at those debt levels, well, based on the orange line, it does appear that things are going to level off here in the next couple of years before actually starting to pick up again in the back end of the year. If you truly, truly want to solve this deficit problem and this debt problem from growing out of control in the long run, something needs to be done with entitlement spending. Because as you look how there's sort of an uptick at the end of the expected debt, net debt as a percentage of GDP on the right, or if you look at sort of the orange bars on the left, and you'll notice that eventually they start rising, a lot of that has to do with forecasts from the Congressional Budget Office, that's who puts these numbers out, for entitlement spending essentially picking up again. So that's ultimately what I think Washington needs to do to solve this problem. It does appear that the fiscal cliff was avoided, and so that is one crisis that we avoided, if you will. But Washington still does, in fact, need to come together and solve this issue in order to keep our debt levels from growing too rapidly, yet at the same time decreasing our deficit in a manner which doesn't threaten pushing the U.S. economy into a recession. So any thoughts or questions? Yeah.
Yeah, I was just going to say the same thing. Any thoughts or questions, anyone?
Hey, Ralph. I was just wondering, can we expect pullback this year, and like, how much would we expect? Kind of generally.
You're talking about the from peak, the typical pullbacks that we get. We have a pullback.
Sure. So we have a page in the Guide to the Markets that I think is kind of useful for addressing that, and it's on page 64. And if we can turn to page 64, there we go.
I'm there.
Let me walk you through what you're looking at here. The gray bars represent calendar year return. So basically, January 1st to December 31st, what was the return in the S&P 500 every single year going back to 1980? The purple dots, if you will, I think those are purple, sort of the little dots, those represent intra-year declines, meaning from any given point in the market, what was the biggest pullback that you had in that one given year? And then as you look at this, it's actually kind of interesting. I think the subtitle really kind of says it all. It says, despite average intra-year drops of 14.7%, think about that, the average drop from peak to trough in 1 year is about 15%, annual returns have actually been positive in 25 of the past 33 years. The message to me is that pullbacks are normal. Pullbacks actually should be expected because they happen just about every single year. As a matter of fact, I don't think I can see one year in here where there isn't a negative purple dot. So you should always expect a pullback, and the average pullback from the peak to the trough, you can see here, is roughly 15%. That doesn't mean that they're always going to be that severe, but there are some pullbacks. I think the message for investors here is this: it's very difficult, if not impossible, to try to time when these pullbacks are going to be and how severe they're going to be. And as a matter of fact, if you notice, 25 of the 33 years, roughly 75% of the time, the calendar year returns are actually positive. So investors end up being better suited staying in the markets and riding the pullback. Now, the question that I'm often asked is, how can I then take advantage of these pullbacks? It really comes down to rebalancing. It really comes down to having, a very disciplined approach to investing. It's sitting down and figuring out how often do I want to rebalance my portfolio from stocks to bonds, so on and so forth. Because if you actually decide on some plan and you have a disciplined approach at sticking to it, that is typically the results which over the long run allow you to take the most advantage of these dips. Great question.
You have a slide or two in here on asset allocation that might help illustrate what you're talking about.
Sure. There are actually quite a few, but let me show you at least what I think is one of my favorites, which is page 63. It's just one before this one. What you have on the very top of this chart, top of this page, you've got two pie charts. And the one to the far left shows you what a traditional portfolio would look like. Let's just say, for instance, I diversified my portfolio between stocks and bonds. And you can see that over a 15-year period or so, the annual return has been roughly 7.4% with a standard deviation, it's just a way of measuring volatility, of roughly 10.8%. But then we said, what if we wanted to diversify that portfolio even just a little bit more? What if I wanted to slice up my bond section? What if I wanted to slice up my equity section a little bit more? And I wanted to include non-correlated asset classes of some kind, whether it's commodities, whether it's REITs, whether it's equity market neutral, just some type of alternative type of investment. And then we're basically doing the exact same thing. We're putting it in the portfolio and we are rebalancing it on a disciplined approach, whether it's quarterly, whether it's semi-annually, whether it's annually, whatever it is, we are in fact rebalancing. And then what you'll notice is that not only are you able to get a better annualized return, it goes from 7.4 to 7.7, but you're also able to do so with a lower standard deviation, meaning a little bit less volatility. By having a more diversified approach to investing, you're basically able to weather the storm a little bit better, and you're also able to take advantage of these pullbacks in the markets when they're there because you are rebalancing. What you really don't want to end up on is like this poor guy that's at the bottom right of this chart. This is actually a study that was put together by Dalbar, it's not us. And they basically look at mutual fund flows in all of these areas, and they basically came out and said the 20-year average returns by asset class are as follows. REITs, if you just threw all of your money in REITs and you kept it in there and you did absolutely nothing, over the past 20 years, you would have gotten an average annualized return of 11.2%. Gold, 8.5%. Stocks, the S&P 500, despite everything you've had going on between 1993 and 2012, believe it or not, if you did nothing, you threw it all in stocks and you left it there and let it ride, annual return of 8%. Oil, 8%. International stocks, 6.5%. Bonds, 6.3%. Of course, interest rates have fallen dramatically, and so that return is not very repeatable, mathematically at least. Homes, despite the fact that the housing market, there was a bubble and it popped, despite that, you still would have been ahead an average of 3% a year, beating inflation at 2.5% a year, and the average investor, unfortunately, coming in at 2.3%. Why is that? Oftentimes it's because they try to time the market rather than just developing the right asset allocation approach, something similar to what you have on the top page over here. How do you construct a portfolio where you capitalize on the upside when things go right and reduce your downside when things go wrong? It's simply about having a well-diversified and well-disciplined approach to investing. And of course, that really comes down to asset allocation. Any other thoughts or questions?
Yeah, I have another question.
Shoot.
What happens when interest rates start to rise?
So what happens, I assume you're talking about the bond market more than the stock market?
Either or both.
Okay. Well, we've got a page on both of those. And so if you want to look, let's just maybe take a quick look at the stock market. And that's on page 12. And from there, we will jump into the bond market. So what you're looking at here is a scatter plot that looks at the correlation. Each of these dots measures the correlation between stock market movements and interest rate movements. And you'll notice that the vertical axis is correlation. And as you know, correlation is bound between -1 and +1. Anytime there's a positive correlation, it means that things are moving in the same direction. Anytime there's a negative correlation, it means things are moving in opposite directions. And you'll notice on the horizontal axis, you then have the 10-year Treasury. It's where are interest rates at that point in time. And what we found is actually very, very interesting. When interest rates are very low, or in this case, let's just call it below 5%, because that's typically where the threshold is. You'll know that's where they go from negative to positive. We put that dotted line. When interest rates are this low, there is a positive correlation between interest rate movements and stock price returns, which basically means when interest rates are this low and interest rates go up, that's generally a good thing for the stock market, and stock prices tend to perform positively. It has a lot to do with sort of this risk-on, risk-off environment. If the 10-year starts to back up from here, it probably means that the bond market has some conviction in the stock market, and markets will actually probably do a little bit better. It isn't until interest rates are higher, and let's just call it 5% or higher than that, that historically at least, an increase in interest rates led to a fall in prices. And that's where you'll notice all of those dots, for the most part, are actually negative. What that really means is when interest rates are high and they're rising, more likely than not, you probably have an inflation problem. So the answer for stock is it depends. When rates are low and they go up, kind of like where we are right now, that would actually be a good thing for stocks. If interest rates are higher, call it 5.5% or higher, and we've got a long ways to go before we get there, and they continue to go up, it probably means you have an inflation problem, and rising rates might actually be a bad thing for stocks. How about fixed income? If you turn to page 33, you'll get just a snapshot of what it means for the bond market. There's a lot of interesting stuff on this page, but just in the interest of time and simplicity, I'm going to focus to the chart that you have on the right. What you're looking at here is the price impact of a 1% rise or fall in interest rates on various areas of the bond market. And what we're basically saying here is if interest rates went up by 1% in each of these key markets, how would these various bonds or these sectors of the bond market react, or how would they perform? And you can see just how sensitive, for instance, a 30-year Treasury is to an increase in interest rates. If the interest rate on the long end of the curve, 30-year basically, went up by 1%, you would see the 30-year Treasury take a hit of approximately 20%. If the interest rate on a 10-year Treasury went up right now by 1%, you would see the 10-year Treasury take a hit by 9.2%. However, as you go down further along the page, you'll notice that it's not all that bad. There are different areas of the bond markets that react differently. The idea here is not to say we want to be out of bonds, because bonds are a very important part of your overall portfolio. They help provide some protection. They help reduce volatility. They help anytime there's a shock in the market, in the system, bonds rally. The answer here is how do you then develop a bond portfolio? And from our perspective, as we look at the data on this page, it really suggests us you need to have a diversified approach to bond investing. Simply putting all of your fixed income holdings in one product, like the Barclays aggregate, for example, isn't necessarily the best way to diversify your portfolio. You definitely need to have some core bonds like the U.S. aggregate, but at the same time, you probably want to have some exposure to U.S. high yield. You may very well want to have some exposure to emerging market debt. That's really between you and your advisor to figure out if it makes sense for you given your risk tolerance. You may want to invest in municipal bonds given the prospects for higher tax rates, and you may want to have some invest in investment-grade corporates, especially given how healthy some of the corporate, some of the private sector balance sheets really look today. Interest rates going up, generally speaking, not a good thing for bonds, but I think the message here is that not all bonds are created equal.
Good points.
So is there any one last question that we've got, either on the markets or the economy or any of these things that we've talked about?
You talked a little bit about emerging markets, unless somebody else wants to jump in. Just some feelings on emerging market exposure, equity versus debt. do you feel about going into emerging markets on either side of the capital spectrum?
Good question. I would use page 40 for that, because I think page 40 just kind of ties in together really what's going on in the emerging market space. Now, this page is really focusing on the equity markets, but I think the same could be true for fixed income. And I would really point your attention to the pie chart you have to the top right. That's looking at market capitalization across the entire world in equities. How many of you would have guessed that the U.S. only makes up 47% of the pie? You know, what do you think that was about 20 years ago? Think about it. It was actually closer to about 65, almost 70% 20 years ago. Emerging markets today on that pie make up 12% of market capitalization. What do you think that was 20 years ago? Well, there's no need to guess. You can actually see what it was on the chart to the far left, and you'll see that it was roughly 2%. Think about how this pie chart used to look like, what it used to look like 20 years ago. Take a good look at what it is now, and then I want you to imagine what you think it's going to look like in another 20 years, given what you see on that pie on that chart to the left, and also given the composition of earnings, how that's evolved, the chart that you have to the bottom left, and then just the sheer size of each of these economies, which you have to the bottom right. Emerging markets today make up over half the global economy, yet they only make up 12% of the pie as it comes to market capitalization. Of course, it's because they're not nearly as developed, but you really have to think about what direction is this heading in, and it should seem pretty clear. I think investors need to have exposure to emerging markets, both on the equity space and on the debt space. Now, a lot of people look at the debt space and they say, well, it's gotten a little bit expensive, and you're absolutely right. From a valuation perspective, it may be getting a little bit stretched. However, emerging market debt is one of the only areas in the world where you can actually still get a decent yield today. So am I nervous about emerging market debt from a valuation standpoint? I think if everyone throws all of their money in emerging market debt, absolutely. But if it's in the context of a well-diversified portfolio, and I'm trying to have some exposure to the emerging markets, both from the equity side and from the debt side, I think it still makes a tremendous amount of sense, because it has a low correlation to other asset classes, and at the same time, it could provide a decent yield. So hopefully that was helpful. I again, don't want to take up any more of everyone's time in the morning here, but I hope we got a chance to answer some of these questions. And of course, if there are other questions that come in afterwards, I'm sure Ralph can probably just forward them on to me, and I'm happy to chat with you guys some more.
Absolutely. Thanks so much, Joe. I really appreciate you taking the time out. I know you've got an incredibly busy schedule, and as a reminder to all of our listeners, this will be recorded and hopefully posted once we clear our compliance regulatory review process. We posted on our website at enduringwealthadvisors.com under the resources tab, videos and interviews, and hopefully you've had a chance to check us out on the video. Here's a couple of the other ones we've done in the recent past, and hopefully you've had a chance to get on there. Also, you can find us, so you can follow us on Twitter at enduring_wealth, and we have an Enduring Wealth Facebook page, as well as both of us here in the office are actively involved in LinkedIn. So thank you for your time.